Hello, Eric. How are you?
Morning, Adam. Good. How you
Good.
doing?
I hope all of you folks who are joining us are doing well. We appreciate get some really nice turnout on Mondays, so we appreciate that. And for those of you who sometimes can't join us for our live presentation, and we are pre-recorded, we are recorded, so you can find the link on the notice that we sent you about an hour ago. Well, Eric, lots to talk about. First and foremost, the weather. The East Coast and the West Coast are becoming very, very similar. We haven't had any rain for a while, so it's very, very dry, and it's been remarkable. It's been like in the 70s, so you could have been jogging here instead of uh, where are you again? Not Malibu.
Santa Monica. Yeah, it's pretty cold in the mornings here. It's like 45 degrees. I'm kind of confused whether I moved or not.
Yeah. Well, I'm sure you're happy there, and we're happy here. And like I said, we've got similar weather now, dry, and we got the fires, and of course we both have the liberals and taxes. So there. So there's that's where we are on your environment and my environment. Let's talk about the environment that we all deal with in the financial markets. I guess we all had a sigh of relief when we saw that the elections were not contested. Of course, half the country didn't like the result, and the other half did like the results. But at least the results weren't contested, and we know who the president is, and there aren't any court challenges or chads on the floor and things like that going on. So that's a relief. And we did have a very quick, almost animal spirit, spontaneous optimism rally on that news. And again, some people might have been also participating because they like what Trump's policies are going to be, and others not so much. Um, I was actually surprised, Eric. The bull bear ratio came out for last week, and so that would have included the election, and I think it rose all the way up to 2.9. I
Wow.
thought it would. I thought it had a chance of making an all-time record high, or at least get above 3.0 and maybe closer to 4.0. So I was kind of puzzled that there wasn't more euphoria, kind of consistent with what we saw in the market. And one fellow I talked to that follows the data quite closely said, well, again, half the country thought that was bullish, and the other half probably thought it was bearish. Even though you and I continue to tell investors, and I'm sure all of you institutional portfolio managers know this, don't let your own personal politics get in the way of your portfolio management, because the market tends to go up pretty consistently, no matter who's in the White House. But now, instead of worrying about Chads and contested elections, now that we have the results, we have to focus on the uncertainty of Trump's policies. So we're very much focused. Everybody's focused on Trump 2.0, and we wrote a piece for today on Trump 2.0, and already got quite a bit of feedback. People with different opinions of what we're missing or what they believe is more important than we think. That's fine. We love that kind of that give and take and that discussion. But just to kind of put an outline of where things are for the discussion. On the positive side, I think widely agreed. Maybe there's something wrong with the thesis that tax cuts, corporate tax cuts, going from 21% to 15% is bullish for the market because it's bullish for earnings. The Trump tax cut back in 2018 lifted the S&P 500 profit margin by about a percentage point. This one could possibly give us a half a percentage point. I think we estimated that the first tax cut amounted to an extra $5 per share in S&P 500 earnings. This one could be $2.50, $3. So that's a positive. A known unknown is deregulation. How much is going to occur? Are they going to take an axe to some of these agencies, eliminate some, or cut, fire a lot of people? There is concern that some of the recent hirings have been particularly strong in government. So if that stops, maybe the labor market gets weaker. On the other hand, deregulation might very well revive animal spirits, make business owners, business managers more optimistic, and decide that it's a good time to hire workers. So deregulation is an issue, and I think generally speaking, viewed as again kind of on the positive side of things, the bullish side. And then one that's not mentioned, but Derek and I have mentioned, is it's conceivable that the markets are giving some credence to the possibility that Donald Trump will make more progress in dealing with or healing the geopolitical crises, the awful war between Ukraine and Russia, and the madness going on in the Middle East. Reading articles are saying that that the incoming administration is already putting a full court press on the Iranians to give up on their nuclear ambitions, and that they have all sorts of sanctions ready to bankrupt the country as quickly as possible. So there's three things I think on the positive side. On the negative side, Eric, we've been talking about trade wars, higher tariffs. The higher tariffs, if they don't cause a trade war, they could be inflationary. So that's something we need to think about. And if the tariffs lead to a trade war, that would be deflationary and cause a recession, as happened in the with the Smoot-Hawley tariff back in May of 1930. Then there's the issue of deportations. How destabilizing is that going to be for the labor market? Will there be all kinds of social upheaval related to that? The incoming head of the incoming borders are, as numerous times said, that the focus is going to be on bad actors, on criminals and potential terrorists. He wasn't saying that they're going to rent out a whole bunch of buses and planes and just load them up with illegal immigrants. But and then there's a history from the Homeland Security on deportations, and previous administrations have deported something like 3 million people, 2 to 3 million people. So there's a precedent for a larger number of deportations. But again, that's a concern on the negative side, that it could lead to more of a labor shortage, higher wages, and so on. Then we've got the issue of what this all does for the deficit. Tax cuts presumably will increase the deficit. Trump's come up with Elon Musk and Vivek Ramaswamy of department to focus on cutting costs, but it's not. I mean, there are clearly a lot of wasteful spending, but they may not add up to big numbers. The big numbers are in mandatory spending. So I think I got that all, Eric. Why don't we look at the charts, and you can go through some of them, and I'll take a few of them as well along the way. And then it'll be good if you discussed the work you're doing now on inflation for the morning briefing for tomorrow. Eric, why don't you go ahead and start on this chart?
Yeah, I mean, this chart is just showing you that it shouldn't matter too much who's in the White House. The stock market tends to do pretty good regardless, and it's earnings, economic growth, and then earnings per share are really what drives stocks higher. So I think deregulation and tax cuts obviously are the most direct impact because it affects your after-tax income, but stocks kind of go up and to the right regardless. And given our projections for economic growth, that's still our story.
Yeah, one of the feedbacks I'm getting from the emails that we've been getting is concern that the difference between one of the differences, there's a lot of differences, but one of the obvious differences between Trump 1.0 and Trump 2.0 is the valuation multiple. The valuation multiple is much higher here. So maybe we have to conclude that the animal spirits story isn't going to be as spirited because there isn't as much room. I mean, valuations are already quite spirited.
Yeah.
With multiples as high as they are. So our story is that we get better than expected economic growth based on productivity, better profit margin because of the tax cut and productivity, and we get an increasingly earnings-led, growth-led market. But I'm reading some of our competitors accentuating the negatives, as some of them are wont to do. And they're talking about a potential trade war and how that's going to depress the economy. One of our competitors who tends to be kind of more in sync with us has been pointing out that this backup in bond yields, which I think he was surprised by, we weren't, is going to lead to a slowdown in the economy. And pointed out that if you take the Citigroup Economic Surprise Index and lead it by 3 months, that seems to I'm sorry, lead the bond yield by 3 months. That's forecasting that there will be a slowdown in the economy, but we're not quite as convinced, and we think that rates are kind of where they should be. So we're not necessarily arguing that they're going to go any higher, but that, of course, is the probably near term risk. This is just something we'll be spending 4 years doing, and that is comparing the Trump's the S&P 500 during Trump's first term and second term, and looks like it's going to, put your seatbelt on, Eric. Looks like it's going to be a bumpy ride. I think Betty Davis once said that in one of her movies, but you may not have seen it. I'll send you the clip for it. Figure three, Eric. So what's the story on tax cuts and the impact on the profit margin?
Yeah, so lower taxes, wider profit margins, better earnings. I don't think 15% is crazy. It's also pretty in line with some other OECD countries. So just getting more competitive on the global scale.
Yeah, this is the 2018 the tax cuts that Trump passed during Trump 1.0 was implemented in 2018. So this is the operating profit margin, and as you can see, it rose by over one percentage point. Not necessarily all related to the tax cut, because there was an upward trend here. And it is interesting to note that a lot of people still think that the profit margin is mostly cyclical, but there actually is an upward trend here. And as a matter of fact, we're thinking that we're going to see new highs in the profit margin in 2025 and 2026. And so obviously the tax cuts that Trump is talking about would benefit that, and so would productivity. But this is just going back to 2017, and you can see that it lifted. We figure if you detrend it, it probably lifted S&P 500 earnings per share by about $5 back then. So $2-3 this time seems plausible. Eric, you're doing some work on inflation now, and a lot of people are concerned about the issue of tariffs. You've written about it. We've both written about the inflationary potential of tariffs. From what I gather, Eric, Trump has mostly said he wants to increase tariffs across the board by 10%, occasionally said 20%, said 60% on China. And you did some work that said that that's not from zero, right?
Yeah. I think the effective tax rate for both China, for US goods to China and also Chinese goods to the US is nearly like 30% anyway. So 60% is very large, but it's just double where we are now. It's not 0 to 60.
It's not 0 to 60. We're not driving a Ferrari here. What's the point of figure 6? What are we looking at here?
Yeah. Consumer prices rise over time, I think, is a story. For people worried about tariff caused inflation. I mean, the whole supply side and goods related inflation pretty much tamed by last year. The New York Fed supply chain index fell negative. So like easing supply chains, goods prices have been deflating. That's not really the core source of where we're getting inflationary pressures right now. It's mostly consumer wages, shelter, the super core core services, ex housing. So we're not really worried that there's some sort of second wave and that tariffs are going to cause it. Second wave of inflation. It's mostly that the kind of more core, U.S. economy focused parts of inflation are getting stuck well above 2%. It's kind of like a too early mission accomplished thing for the Fed rather than
Mhm.
tariffs are the big worry.
Yeah, I think one of the issues on rents, I mean, we're all watching the market rents data and it still looks like it's disinflating. And so you kind of scratch your head saying, what's the Bureau of Labor Statistic saying? And maybe it's the fact that, home prices are at an all-time record high and that's forcing more and more people to rent. And
Yeah,
maybe whatever sample the BLS is using is showing more of that than the market's rates data. But clearly, what's important here is what the CPI and PCED rent numbers actually do. And didn't we do something on the 3 month? The 3 month doesn't look that happy, right?
no, 3 month for shelter CPI has been accelerating since July.
Yeah,
So that just points to a higher year over year or less disinflation on a year over
yeah,
year basis.
yeah.
I know the San Francisco Fed, which obviously skews liberal, but they've been doing research showing that the reason that the whole new market rents that are much lower isn't being factored in is because they jumped way higher than shelter CPI did
Hmm.
during the pandemic. So there's still plenty of catching up to do. At least that's what they're saying. So
That's a good point, though.
yeah,
Yeah. Figure seven. I don't know. We're trying to get a sense of how big a deal tariff inflation might be. One of the points in this chart is there were a bunch of tariffs that Trump imposed here, and it's a ratio scale, so you're not really seeing anything that suggests that inflation was boosted on a CPI basis, and that's core CPI. So we're not doing food or energy. So there's not much there, and that's maybe because imports of goods. I presume that the tariffs would be mostly on goods, but I guess they could be on services. But just goods is where you would expect to have the biggest impact from China, and goods account for roughly 12% of nominal GDP. So it's not insignificant, but it may not be significant enough that a tariff of 10, 20% across the board. Eric, I think the point of that tariff isn't to negotiate better deals. I think it's just to raise some revenue so you can pay
yeah,
for some tax cuts. So let's look at that issue of whether 10, 20% can what kind of revenues that can generate. You want to take it away here on figure eight, and then I'll get you to nine and 10.
yeah. I mean, it's custom duties here, but tariffs are pretty paltry amount of income for the government. It was like $84 billion last year, or the 12
And
months ended September, or something like that. That's just not a lot of money, right? So even increasing it, that's not going to fund a huge portion of otherwise deficit increasing policies. And then this
so,
is that, yeah, this is that gamed out by tariffs. So like, if you blend a 60% tariff on China and a 20% tariff on everyone else, which is like the most hawkish baseline, you get like a 26% tariff. So you get about $1 trillion raised. It's definitely a significant chunk of money, right? It probably offsets the 21% to the 15% corporate tax rate getting lowered. But that's like what net interest costs are, right? So it's not exactly deficit reducing, though it may offset otherwise unfunded tax cuts.
yeah, and it's not clear. I mean, it's not clear whether it's going to be 10% or 20%. It's not clear if it's going to be
Yeah.
across the board.
How quickly it
Yeah,
gets.
how quickly it
Yeah.
happens. And I think we still have to do some work on the extent to which the executive branch under Trump has the power to just willy-nilly impose that kind of tax. You would think the Congress would need to get involved, but it got a little murky back after the Smoot-Hawley tariff. Congress was so upset with what they had done to cause the depression with the tariffs that they voted to give more power to the executive branch to deal with trade issues. But Eric, that I think let's put on our to-do list because I'm sure it's
Yeah.
there somewhere. But let's look at that, the extent to which he can just sign an executive order and say everybody's got to pay a 10% tariff. The notion that foreigners are going to pay it is a silly one. I mean, it's going to be reflected in domestic prices. It'll get passed through. But then the question is, how big a deal might it be? It's certainly going to be inflationary. The only question is, will it show up on the radar screen? Will we see it on something like this?
Yeah.
And
I
then the
noticed.
other thing is, Eric, I got a pushback this morning on the notion. We've been saying that, okay, so let's say that the tariffs are somewhat inflationary. Uh, Trump is also pushing to drill, baby, drill, and so if that happens, that should keep energy prices down, and energy prices are probably at least, if not much more important than tariffs. If
Hmm.
he's able to keep the global oil price down, that would obviously help on the inflation side. But somebody kind of pushed back and said, well, just because he says he wants the U.S. to produce more doesn't mean that that's going to happen if the price is lower. So, I mean, that's kind of a reasonable point. But the price may be lower just because people realize that the accessible reserves under the ground are now much bigger, particularly, especially in the United States, and that
Hmm.
might work to keep oil prices down. So it's a lot of moving parts here. We'll and everybody's free to put whatever weights they want to on these things, but we'll try to be as objective as we can about these things. Yeah, this just looks at the uh, the outlays that the government has, and says, where's Elon and Vivek? Where are they going to start in all this? They can't do very much about income security, health, Medicare, and Social Security, Medicaid. Can't do anything about net interest, and they probably don't want to do anything about defense. So it may leave them with about $1 trillion of discretionary uh, spending by the government that perhaps they can cut into, find a lot of wasteful things, and so on. And so that's not trivial, and we think it's significant. In addition, there's something called tax and tax entitlements. Where you get the deductions and so on, and they add up to over $1 trillion. So there's room for cutting there. But all these things have constituencies, and politicians kind of fighting back for their constituencies. Eric, looks like we left some good time here for some Q&A. So far, we got three. So why don't you folks take advantage of the spare time we have and give us a few more questions as we answer the first three. Go ahead, Eric.
So the first one, do you think that unleashing animal spirits by the new administration can eventually lead to a boom bust, akin to 2008, or I suppose, 1920, whatever?
Yeah, I mean, it really looked like we had some good animal spirits there for a day or two after the election results. And then everybody started to focus on, well, it's complicated. There's a lot of moving parts. It could be positive, it could be negative. Had a conversation with one fellow who emailed me saying, that I got that we got the timing wrong. I'm going to blame both of us, Eric. He said that I got the timing wrong, and that all the bad things are going to happen first before the good things happen. So it is kind of complicated in that regard. I'm sensing that animals. Maybe I don't recall the exact pace of animal spirits and how long they lasted when Trump first won, but it seems to me that these are petering out a little faster than we saw with the first. But look, it's only 2 weeks into this whole thing, and uh, Eric, we just pointed out last night in the QT in the quick takes, we pointed out that the first of the five business surveys, regional business surveys, New York just went straight to the moon in November, just
Yeah,
straight up, like high since 2021.
this is before the Fed started hiking. Yeah.
Yeah, right before. So maybe that's kind of the first tip of it. It's the New York Fed business survey, I think, is really one of the first indicators we have for the month
Yeah.
ahead. Um, and so we'll be watching that. We gotta believe, we expect that some of the confidence indicators we're going to see in the National Federation of Independent Businesses will rebound. I mean, Yeah, this administration's promising tax cuts and deregulation. Whoopee. I mean, that's gotta get their animal spirits going. So maybe we'll start to actually see it in the labor market that companies that have been holding off expanding because they didn't know who's going to win and what the policies might be. Maybe on balance, while we in the financial market sometimes tend to have a pessimistic bent, we're looking for what could go wrong. A lot of these people might be looking at it a different way in terms of what could go right. Go ahead, Eric.
This one's from Cactus. Ed, thanks for the update. How are you thinking about commodities in the Trump 2.0 world from a macro perspective? Bullish or bearish story overall?
Neutral, kind of in the middle, kind of where they've been. China's stimulating, but maybe what they'll do is kind of stabilize their housing market. But I kind of doubt that they're going to go and be developing a lot of new apartment buildings. So the demand for iron has been the iron price of iron is what we're watching. That's been weak. We're watching the price of copper that hasn't gone anywhere. Um, Europe looks like it's going to be weak. The German manufacturing sector is getting pummeled by competition from China. Remember, they used to sell Mercedes and Beamers to China. Now the Chinese are sending everybody else electric vehicles, and the Chinese want to drive electric vehicles, which also, by the way, feeds into weaker oil prices. You got any other thoughts on that, Eric? I mean, it kind of looks like
Yeah.
sideways.
Yeah, I mean, like one way ostensibly China would pay for the tariffs or fight them is to devalue the yuan, which is a stronger dollar policy. I know Trump wants a weaker dollar, but like in the short to intermediate term, that strong dollar. So then commodity prices arguably stay tame. So yeah, it's tough to be bearish commodities when you're positive on U.S. growth, but it's also hard to be bullish. And being bullish a variety of commodities, basically ex gold for the past year, has been pretty tough.
And we've been fundamentally bullish on the dollar. I mean, it's wicked volatile, but we still kind of don't think it's going to take a dive, and we think it's going to at least hold its own, which is relatively strong, especially compared to the euro and the yen.
Mm.
A strong dollar is not a great environment for a bull market in commodities. Go ahead, Eric.
So this next one from Chip. Considering the increasing deficit, Dr. Ed, if you were if you were summoned to fix the problem, how would you go about it?
I'd hire Elon Musk. Yeah, I think that was I think that was pretty clever because I think it bought incoming administration some time. We can't know for sure whether this Doge committee, this Department of Government Efficiency, is going to succeed. Again, I recommend to all of you reading Elon Musk by Walter Isaacson, and he's definitely obsessed with cost cutting. He really enjoys it. And if somebody is working for him that just doesn't seem to get it, he fires them and hires somebody else who gets it. But his instincts for what can be cut and how fast it can be cut are really quite remarkable, at least according to the book. But that's with regards to building cars and rockets. It's a whole different ball game when we talk about the government. So it's we'll see how that plays out. But I guess if there were no, I mean, the whole problem is the politics of it all, and the country's split in half, and one half wants more government spending, and the other half wants less government spending and less taxes. The other side wants more government spending and more taxes. So it's hard to get these things reconciled. But there is a window here that Trump has in which they could make a credible move to reduce the growth rate of outlays. They don't have to slash outlays, just meaningfully slash the growth rate of outlays, and um, and then find more revenues. If I sound like a politician, it's because it is a political issue at the end of the day. So if we want to do it, we can do it. And I think this administration wants to do it.
All right, let's jump around. This is from Ian. Your thoughts on rents declining as interest rates decline, which enables more home buying, including possibly looser home building regulations under this administration.
You want to take that?
Yeah, I mean, like, I don't know how prices would fall, and I don't know if mortgage rates are going to fall all that much. Like, we have 75 basis points of cuts and a higher long end, so we have 7% mortgage rates. I mean, eventually, like, buying a home is not as much a discretionary decision as like a life decision, right? So eventually, millennials and maybe Gen Z will start to purchase homes. So you just get that demand rolling over, and it's a positive. But new home sales have been good. There's been lots of building. Home builders have been off to the races in terms of stocks, but existing home sales are kind of the place you need to see some turnover. So
Yeah. Okay. I mean, given Ian's assumptions, if rates go down, if that boosts home sales and that takes rent inflation down, then that's a whole different scenario. But it's
yeah.
it's hard to see it anytime soon. Go ahead, Eric.
Um, any thoughts
One.
on Treasury Secretary?
Not really. No. I guess it's the percent and the other fellow. I only remember names once they actually get appointed. But no, not really. I mean, I think no, no. I don't have an opinion. Take one more.
We can take one more. Yeah, from Ted. The Fed's vacillating now regarding December. What do you think on a possible rate cut?
Well, we've been wrong because the the Fed just won't listen to us. Um, I think we've been right about the fundamentals. The economy has been stronger than they expected, and inflation is turning out to be a little stickier in some areas, and yet they still went ahead and cut by 75 basis points. And so Powell's speech on Friday or comments on Friday suddenly kind of were very consistent with our view is that there's no rush to cut rates from here. That wasn't in last month either, but now he seems to have turned a little less dovish, a little bit more hawkish. But he's still talking about lowering rates. He's just saying there's no rush to do it here. Eric, thanks as always for joining me as in these conversations. Thank you all for tuning in, and have a good week. We'll see you next week.
Thanks, everyone. Have a good one.